Hello and welcome. You tune into Market Fatafat with me, Ankita Saxena, and with me is Kanishka Sarkar. In the next half an hour, we'll take you through all the stocks that are in focus in the trading session today. But first, let's take stock of how the market is shaping up. Well, after that sixth consecutive session of, advances that we saw coming in the market, we do see profit booking that's happening all across the board. In fact, benchmark indices, Nifty is down almost 0.5% at this point. It is trading at the lowest point of the day. 25,761 is where Nifty is perched at. Nifty Bank also following suit. That is also declining almost 500 points, 0.8% decline coming in. It is at the lowest point of the day right now. 57,574 is where the Nifty Bank is at. And the broader indices, the broader markets are also, mirroring the frontline index. Mid cap is also down to 0.1%. Now 0.4%. That's also trading towards the lowest point of the day. And small cap has also taken a plunge. And as you can see, all these indices are currently trading at the lowest point of the day. Small caps also trading with cuts of 0.3%. Let's talk about the sectors then. Barring metals, realty and energy, that's marginally in the green. All the other sectoral indices are in the red, especially the FMCG that is taking the sharpest knock, down almost 1% in trade. Colgate, Parle, as we mentioned, is down and out 3% on the back of weak set of numbers coming in. So the FMCG pack entirely is reeling under pressure on the back of that muted sentiment. But that's how largely the market is shaping up. Kanishka, we do see profit booking coming in across board right now.
Absolutely, a little bit of profit booking coming there. But moving on, before we start discussing all the top buzzers today, let's take a quick look at India's consumption story. Now, the GST rate rationalization in FMCG industry had led to inconvenient pricing for small packs. Sources are now telling ET now that FMCG companies are rolling out new packs with higher volumes at same prices to pass on the GST benefits. Anjali Palod, my colleague, is here to take us through all the details.
Right, so in the FMCG industry, it was the small packs that was having some sort of inconvenience coming in with the GST rate rationalization, and now FMCG companies have decided to increase the volume in these small packs. So your 2, 5, 10, 20 rupee packs will be seeing these volume increases in the coming weeks. In fact, when the reduction in GST rates was announced, the small packs had come down to inconvenient pricing points with the GST rate cuts. And now, in order to make sure that the GST rates are still passed on, but the pricing is convenient, FMCG companies are going to increase the volumes or the grammages on this pack. Nestle, for example, had started production of new packs in September. That's what we're gathering according to sources. And since then, the traders were still expected to, sell out the existing stock, and now they're left with minimal stock that was at the previous pack sizes, and now the new pack sizes will be sold. A spokesperson from Parle confirmed to ET now, saying that they will roll out the new packs by the end of October or the first fortnight of November. Meanwhile, SUL distributors have said that they haven't received the new packs yet, but they are likely to receive them by the end of this month. So what kind of impact will we see in the smaller pack sizes? If you talk about Nestle, they are going to increase the grammage, especially if you look at the Nescafe, which is the coffee brand. So all packages that are less than 45 grams, there we will see some grammage increases in order to ensure that the prices still remain at the magic price points of 5, 10, 2 rupee. Now, Maggi grammage has been increased from 280 grams to 300 grams. Talking about Parle, they are increasing grammage by about 6 to 14% across different categories like snacks, confectioneries, as well as chocolates. But that's the one shift that we are noticing in the FMCG industry, and you'll see these changes likely by the first week of November.
All right, thank you, Anjali, for taking us through those details. So some volume changes likely for small packs going forward in the FMCG industry. But then let's get started discussing all the top buzzers. And today on the technicals, we're joined by Kunal Shah, who's a senior technical analyst and derivative analyst at Mirae Asset Sharekhan. Hi, Kunal. Thank you so much for joining us today. Well, let's get started then. And first up, let's put the spotlight on the defense pack. Now, obviously, this is coming after the Defense Acquisition Council yesterday approved about 79,000 crores in new procurement proposals. Now, key approvals include the NAG missile system, MK2, the ground-based mobile ELINT system, and high-mobility vehicles, which will strengthen the Army's capabilities against enemy combat vehicles and bunkers. Now, for the Navy specifically, a 33,000 crore deal for 4 landing platform docks was also cleared, along with 30 mm naval surface guns and advanced lightweight torpedoes, boosting India's ambitious naval sector. On the other hand, for the Air Force, they are going to collaborate with, they will see the collaborative long-range target saturation or destruction system move forward. So yes, lots of announcements coming for the defense sector. Now, these procurements are part of the Make in India initiative, are going to promote self-reliance, and major defense companies like Cochin Shipyard, MDL, BEL, HAL, Bharat Dynamics, they're all expected to benefit, once these proposals turn into orders for these companies. Now, according to Citi, the approvals are seen a span across missiles, surveillance systems, naval guns, torpedoes, sensors, ammunition, autonomous aerial systems, and also high mobility vehicles, like we pointed out earlier. So order cover both short and long gestation projects. That's going to happen for all of these companies, and hence the defense pack is yet again in focus. After a 1 to 1.5 month period of lull, we are now again seeing action in the defense pack, as you can see on your screens. So yes, defense pack in the focus there.
Defense pack that is in focus on the back of that approval of 79,000 crore worth of new procurement proposals by the Defense Ministry. But Kunal, you have also picked up BEML. Now, BEML is also in focus. It's jumped up 4% today on the back of this news flow, and also the fact that they've signed an MOU with the Tesmec Italy, and they're introducing surface mine equipment, for mining applications. On the back of that, BEML is in focus on the back of that fundamental news flow. But on the charts, what do you see? Because the stock has run up quite a bit. It's up 40% in the last 6 months. So there's clearly, a big rally that has already happened. Do you see there's more upside on BEML?
Yeah, good afternoon. Good afternoon, everyone. I think definitely in the last, if you see the 6 months, the pain through which the market has gone through, BEML has been one stock which has been resilient. And we are seeing clear-cut outperformance in the stock, and we expect this outperformance to continue going forward as well. So on the technical front, we have seen an inverted head and shoulder pattern form, which is a bullish reversal. The stock is on the verge of a breakout, and we expect this momentum to continue towards the mark of 4,800. So BML looks attractive at the current levels. One can start accumulating at the current levels. The lower end support for the stock is placed at 4,200. I'm expecting the stock to go towards 4,800, 5,000 levels in the next 1 month.
BEML on the charts as well. But let's move on to the next pack that is in focus. In fact, the entire aluminium pack is in focus today. Names like Hindalco, that's up 3%. That's the top Nifty gain. And Nalco is up 4%. And so is Vedanta, that's trading up 2.7%. Now, why are these counters up in a way? Because of the fact that the aluminium prices have surged. That is led by supply shortage. Now, if you look at the aluminium prices on LME, that has crossed $2,850 per ton mark, and that's up almost 2% since yesterday. Now, what is causing really, this price rise, the shortage in the global market? The fact that Europe faces an unprecedented challenge in securing environmentally sustainable primary aluminium. That's one. And the second reason is that, the curtailment of, production at one of the 3 aluminium smelters in Iceland is also causing this sort of a shortage for aluminium, and therefore the hike in prices of aluminium. And on the back of that, entire aluminium basket is in focus today. Hindalco, Nalco, Vedanta, all trading upwards of 2+%.
That's right. So all the metal-related counters trading upwards on the back of that aluminium price hike. But Kunal, you have also picked out Vedanta and Nalco for us. Stellar moves coming in today, but do you think this kind of up move is sustainable for these counters?
I think definitely. I think that commodity is in a super cycle, and this generally super cycle lasts for 4 to 5 years, and we are in the bull run. So Nifty Metal as an index, if I talk about firstly, it had already given us a breakout earlier around the mark of 9,500, 600 zone. Potential targets for this is 11,000, 11,300. Currently, we are trading at 10,300. So clearly, more close to 1,000 points upside is left. And out of these, I think both Nalco, something which is looking very strong on the charts. Already, it has been forming a heart of high bottom formation and is likely to touch its all-time high level, which is placed at 258, 260 on the upside. So Nalco is a buy on any dips. Whatever you get, utilize that dips to buy. The support for the stock is now placed at 210 on the downside. So dips to be utilized as a buying opportunity since the stock has run up a little bit. But I'm expecting the stock to go towards 255, 260 in the very short term. Similar, the case for Vedanta as well. Vedanta has also given us a fresh breakout in today's trading session. So this can be accumulated at the current levels. It was stuck in this range of 460, 470, which it has taken out in today's trading session. And we expect this move to continue on the higher end. So even Vedanta is a buy at the current levels only, keeping a stop loss of 460 on the downside and looking for targets of 530 to 550 in the next 1 month.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll keep getting you more buzzers on the other side. Stay tuned.
Hi there, welcome back to ET. Now you're watching Market Fatafat with me, Kanishka Sarkar and Ankita Saxena. Well, time now to take a look at some of the FMCG stocks that are buzzing in trade today. First up, let's talk about Colgate Palmolive. Now, this one is in focus after the company reported a weak Q2 FY26 performance, missing estimates on revenue, EBITDA and net profit as well, while margins that came in line. Now, on a standalone basis, revenue fell about 6.3% on a year-on-year basis, EBITDA dropped 7% and profit saw a decline of 17% there. Now, EBITDA margin, that was largely stable at the 30.1% level. That's just down about 21 basis points. So yes, that was a pretty decent number as far as the margin is concerned. But on all other metrics, it did not meet the street's expectations. Other than that, advertising expenses were down about 7.3%. So that's a key positive there. Other than that, the management has highlighted that the quarter was challenging due to a high base and GST-related disruptions. Though investment behind brands continues, the CEO has also noted that oral care portfolio GST rate fell from 18% to 5%. That's causing some transitory channel disruptions with a gradual recovery expected in the second half of 26, that is FY26. Brokerages, they've also reacted sort of cautiously. Goldman Sachs, Investec and CLSA, they've maintained their sell or hold ratings with lower target prices, while JP Morgan has downgraded the stock to neutral. So that's how the brokerages are reacting to the results. On the other hand, Nuvama and Jefferies, they continue to maintain their buy stance on Colgate Palmolive. So yes, that's the reason why this one is in focus on the back of weak Q2 numbers.
Well, yes, weak Q2 numbers coming in from Colgate Palmolive. In the back of that, that's the biggest FMCG laggard, and that's dampening the sentiment in the entire FMCG pack as well, which is the top sectoral loser. But let's talk about another counter from the FMCG pack, and that's HUL. Now, remember, HUL posted its number yesterday, and that beat the street expectations, and HUL was doing very well in the trading session. But today we have brokerage notes that have come out. The first one is from Citi, that's maintaining a target price of 3,000 versus an earlier 2,900 target price, and they're maintaining a buy call. They feel that HUL's Q2 results were slightly ahead of expectations. Although the underlying demand trends were stable, quarterly growth was adversely impacted by the transitory trade destocking in anticipation of the GST rate cuts. Now, the management expects a 200 bips impact on growth, and the normal trading conditions are expected to resume by early November. Now, they're focused on execution of initiatives that could accelerate the medium-term growth, and they estimate an 8% and 9% FY25 to 28 estimated revenues and the EPS CAGR respectively. And the segment trends, according to them, they see strong volume performance in home care, skin care and colored cosmetics. And they also see the hair care and skin cleansing and oral care that are likely to be impacted by the GST transition. Also, we have Goldman Sachs that is maintaining a buy call with a target price of 2,850. So a couple of brokerage notes that are maintaining their buy call on HUL, but they're maintaining a rather cautious stance.
That's absolutely right. Cautious stance on both of these FMCG players. But moving on, Kunal, you have picked out Blue Star for us. Very flattish moves on this stock in the recent weeks. Where do you see the stock headed from here on?
So I think, yes, definitely. The stock has been consolidating in a broader range, and today finally we see a good breakout in the stock, which has been backed by volumes. So we expect this move to continue on the upside. On the lower end, 1850 is now a very strong base for the stock, and we expect the stock to move towards the mark of 2200, 2250, which is from the current levels almost close to 10% upside what you can get in the next 1 to 2 months. So this looks attractive from a risk to reward perspective as well. So Blue Star could be bought at the current levels.
All right, so that's Blue Star for you. But moving on to the next counter that is in focus, it's EPAC Prefab Tech. Now, this one is in focus after a strong Q2 FY26 performance. The company reported a revenue of 434 crore rupees. That's up 62% YOY, 47% on a quarter-on-quarter basis, whereas the net profit, that seems to have more than doubled to 29.5 crore rupees. Now, it's a recent debutant on the street. Now, the company's prefab division, that has contributed 652 crore rupees in the first half of the fiscal. This was backed by a robust order book of 920 crore rupees with additions of 655 crore in just the first half. Now, EPAC continues to expand commissioning capacity. It has commissioned a continuous sandwich panel line at Mamabatu and planning further brownfield expansions as well. And that's the reason why this counter is in focus after a strong Q2 performance. In fact, we had a word with the management as well, and let's see what is their outlook. They have maintained their margin guidance of 10.5 to 11.5%. And let's take a look what else they had to say about the outlook going forward.
We have done an order book of around 650 crores in this financial year. The target is to get the figure to around 1600 to 1700 crores so that we can open the year with around 1200 crores. We can open the next financial year with around 1200 crores of order book, pending order book with us. In terms of margin, first of all, we are committed to maintain the margin at 10.5 to 11.5. That's the guidance we are giving. Although in the second quarter, the margins are 11.5%. But we don't want to overcommit to the market. Secondly, our strategy has always been a market penetration strategy. For us, growth is much more important than margin expansion right now. We want to penetrate deep into the market and have a major share of the overall prefab and the pre-engineered building market. And thirdly, in terms of future, we have been growing at around 45 to 47% CAGR in the last 4 years. And we want to maintain the same kind of, momentum in the company.
All right, with that, we're completely timed out in this edition of Market Fatafat. Thank you so much for joining us. Kanishka and I will take your leave. Thank you so much for tuning in.